Two AI stocks that can benefit from lower rates. And to be honest, they can benefit dramatically from the crazy AI demand that we're seeing right now. On today's episode, what I want to do is take a closer look at two stocks that are $10 billion or below in market cap. One is going to be a data center AI infrastructure play, and the other one is going to be an energy play. And for those that are familiar with this channel, you guys know that I'm not too excited about the energy market, but this one is sitting at a market cap of $2.5 billion. And in my opinion, it's looking pretty interesting. Let's take a closer look in today's episode. All right. So first, let's kind of start off with the data center company. This is going to be stock Iren, ticker IREN. Now, luckily, if you have been following this channel, about a month ago, I did 15 secret AI stocks that could make millionaires in 2025. Unfortunately, that video did not do so well, only about 7,000 views. Now, through that video, I took a closer look at 15 different PowerShell and AI data center companies. One of those was Iren when the stock was sitting at $19.69. Now the stock is sitting at roughly $38.36 after hours. This is a company with a market cap of $10.3 billion. And if this AI story is real, I can definitely see the opportunity, not the guaranteed, but the opportunity for stock prices to continue to go up. Now, throughout this episode, we're going to be using my favorite platform when it comes to data. I use it on a daily basis. If you are serious about long-term investing, about investing in general, check out fiscal.ai/Jose for overviews, financial transcripts, a lot of cool AI solutions, and at a really great price. I'm going to say it's pretty cheap for everything you get, plus the 15% off with the link below. So Iren, again, like I mentioned, is a company that's building AI infrastructure. And we're going to take a closer look at some of the business opportunities that they have. They have kind of like this hybrid approach. And I believe there's not many places out there on YouTube right now that are going to give the information that I'm showing in today's episode. Now, the first thing I want to look at is kind of quarterly revenue growth. This is a company that has been benefiting dramatically from their previous Bitcoin mining endeavors and now kind of transforming into the AI cloud space. And this is what we're seeing a lot of companies do, where they're transforming from Bitcoin miners to high performing cloud AI computing stocks. In the most recent earnings, which they reported for their June 25th quarter, the revenue was up 223%. Now, if we look at forward PE ratios for a company growing dramatically, it's currently sitting at 35.87. In forms of just price right now, it doesn't seem the craziest, right? It does seem crazy compared to maybe where you might have seen it a year ago. In the low 20s, in the low teens. But historically, with this AI market, there is opportunity as we are growing in this space dramatically. Now, some things to kind of notice is total cash, which is green, is sitting at $564 million in the last quarter. They did increase their debt from nothing to about $1 billion in one quarter. And if you are following the AI market, you know one thing. AI infrastructure is expensive. Buying these GPUs, building these data centers costs money. I think it's okay in the current ecosystem that we're in, especially if rates are getting lower, right? That's obviously going to be beneficial for future financing on even more GPUs. But we're seeing this from all the other players. Coreweave, massive debt. Nebius building $3 billion of debt extra after their $1 billion, so sitting more at $4 billion in debt in the last quarter. That is needed for this AI infrastructure build out. Now let's take a highlight of the company. They share a lot of information in their quarter earnings in the slideshow here, so would recommend. But we can see record results. Revenue for their fiscal year of 2025 was $501 million. This was for the full year, up 168%. In forms of operational, they had about 2.9 gigawatts of contracted grid connections, 810 megawatts of operating data centers, and most of the money we're going to see is coming from Bitcoin mining. This is where they've done really, really well. That's up about 400%. They are building their AI GPU cluster. Right now, they have about 1.9 thousand running at the end of that quarter. They have roughly $1.25 billion in annualized revenue. 1 billion or so, a little bit over 1 billion is coming from the Bitcoin mining. GPU as a service, or the AI cloud, is expected to be roughly 200 to 250 million annualized by the end of December of 2025. Now, the main reason is they're scaling from 1.9 thousand GPUs to roughly 11,000 in the coming months. Now, the growth outlook, as we're going to see, is for them, they're really pushing into the AI data center. And some might be wondering, Jose, why is this company shifting from Bitcoin mining to cloud computing? It's a completely shift of business. Doesn't that kind of give some red flags? Now, luckily, we'll kind of come back to this presentation, but I do want to answer that question first. Luckily, Iren has had a few interviews. This is one that I definitely would recommend at Schwab Network. It was about a 6-minute interview, and the CEO mentions that when they founded Iren, the reason they went with Bitcoin was because it was the digital currency. But one thing that their overall thesis for building the company was the world was transforming into a more digital world. And now with AI solutions, with tokenization, that is still the truth. Now, when they started, the biggest aspect was Bitcoin, the digital currency. But now it seems like it's transforming and the growth opportunity is there for AI. So I don't know if he's just throwing this out of his butt or whatever, or he's just kind of making it up. But if it is true, at least on a top level thesis, the market for them should still be very similar. And the overall opportunities that they were trying to push is still the same. It's just in another avenue, like we saw the AI market. Now, one of the biggest things with AI market right now is we are power constraints. And that's where Iron looks pretty good. They have a lot and a lot of capacity in forms of AI data centers, right? British Columbia, 160 megawatts. Childress, 750 megawatts. Sweetwater in Texas, I believe, that one's over almost 2 gigawatts of potential power available to it. Now it's all in 2 steps. Some of these are not operational, some are. Luckily, the company throughout the late presentation will give us the information of which ones are working right now and which ones are not. But overall, the company is doing really well with that infrastructure. And right now, power constraint is a massive, massive bottleneck in the AI market. That's why we're seeing these massive investments from the big tech players, either buying, investing in co-location companies, or just renting out kind of AI capacity from the other AI infrastructures. We saw kind of TerraWolf with Google. We saw Nebius with Microsoft. We see OpenAI with CoreWeave. We see Google with CoreWeave, and the list goes on. The reason being, power is a major, major bottleneck. Now, one of the other things that they're pretty excited about is recently they did announce that they became an NVIDIA preferred partner. This does a few things. Allows them to get equipment a lot faster, or capacity a lot faster, but it also is like in the metal. It's indication that if you work with them, you're working with one of the best, and that gives at least some credibility, increases the credibility. That's what I wanted to kind of discuss. Now, Iron's GPU composition is mainly focused in the Blackwell market, and in forms of annualized numbers, we see for June 25, it's sitting at around $26 million because of the massive growth that they are seeing here in the Blackwell GPUs and how they should be turning on pretty soon. They expect annualized numbers to be closer to 200 to 250 million by the end of this year. I think that is pretty wild. Now, they also kind of give us an illustrative revenue payback. They mentioned with the kind of contracts that they're seeing right now, in about 2 years, they pay back the GPUs. In about 3 years, they pay back the GPUs and the infrastructure. So if they can kind of make contracts for 4 years for a lot of these capacities, and a lot of these players are making more than 3 years of contracts for AI GPUs, then they make their money plus more. They're also building various opportunities. We can see in this plant, Prince George, they expect capacity of over 20,000 Blackwell GPUs. Here we can see the capacity in British Columbia. All of British Columbia's, they have capacity for over 60,000 Blackwell GPUs. Now, the other thing that we're seeing here is data centers come online in segments. It's not like you get everything turned on. Right now, Horizon 1, 50 megawatt IT on track for quarter 4. We also see Horizon 2 on track for later on as well. Sweetwater, which is the 2 gigawatt, is expected to have 1.4 gigawatts energization on track for April 2026. The other 600 megawatts scheduled for late 2027. Now, this isn't full IT power. This is when at least the power enters the infrastructure, but then they still have to do a little bit more. They are already advancing discussions with prospective customers. As the AI market right now, you need to have these contracts available as soon as possible. And if you're able to meet these deadlines, you're going to get a lot of contracts. And we can see that's one of the main reasons that investors are pretty excited about Iren. We can see here the overall capacity that they're trying to build out. By the second half of 2025, they expect about 885 megawatts. First half of 2026, jump up dramatically, mainly due to that Sweetwater 1 and Sweetwater 2. They also just recently got a new CFO. I wouldn't say this is bullish or bearish, but some people like to understand any major management change. On December 8th, they did appoint Anthony Lewis as Chief Financial Officer. Prior to this, Mr. Lewis was the Chief Capital Officer. Now, if you want to get a lot more information in Iren, I would say take 2 hours of your time if you really are curious about this stock. If you go to Iren's website, if you go to the resources and videos, on September 4th of 2025, there was a quick podcast after the earnings, kind of a Q&A session. It's about 45 minutes. Definitely check it out. And like I mentioned on Schwab Network, that 6-minute video explains a lot of the industry and how management sees this overall space. Now, I have one more thing I want to show with Iren before I move on and kind of look at the core strategic philosophy. So one thing for Iren is, and just for the overall AI space, we're seeing 2 different types of market opportunities. You have co-location. So co-location, for those that are not familiar, is when you end up just renting out the land and you let the customer that rented out the land put in everything else. So you create the overall power shell, you create the data center outside, but they handle everything else. They handle the inside, they handle rolling in. Then there's the AI cloud compute where you build your own power shell, you build the infrastructure and everything, and you also put in your own AI GPUs and you rent it out. There was a question most recently, what is Iren doing? Which one is their preferred method? And they believe that's one of their advantages. They are highly flexible. They have non-exclusive approach to monetization. They don't focus on a binary choice where you have to choose either cloud or co-location. And even within their areas, you can have certain parts be co-location and certain parts be their own AI cloud. Now, they did give us a risk to return profile for co-locations. These are usually longer dated contracts, 5 to 20 years. They are, though, lower payback periods, often 7 years, but you don't have to build that AI infrastructure yourself. So it's less expensive to start it off, but it takes longer to get the payback. Obviously, if it's something that's less risky, you get less money for it and minimal cash flow during debt financing. Now, the cloud model, these are shorter dated contracts. They have much stronger margins and they have shorter paybacks. 2 years for the GPUs, 3 or 4 years for the full infrastructure. Again, the great thing is if they own both, they can do a few years in one and then shift it off to another and still make money at the end of the day. So for them, the non-binary approach makes perfect sense. Now, in forms of, they believe one of the strengths for them is that most of the co-location customers that they're talking for significantly value the fact that they understand how to operate these clusters at scale. They know how to design data centers to operate these clusters, and they proved out throughout their own cloud services that they can operate at very efficiency levels. So for that reason, a lot of customers seem to like them for their co-location. Now, I talked about it in the past, right? About $1.25 billion in annualized revenue right now. Most of it is coming from Bitcoin, but they see line of sight to billions of more from AI cloud alone as they continue to build up that infrastructure. Now, one thing that Iron does that maybe some of the other players do a little bit different is they like to buy GPUs nonstop. They just like to buy it, right? Where some other players like CoreWeave and Nebius, they take a little bit more safe approach where they wait for the contract to come in. Once the contract comes in, then they build out that AI infrastructure. Iron does it a little bit different. They like, if we have the power and we want to build it, we're going to build it. And then the contracts come in for their Blackwell system. Where do I have it? The strategic. Here we go. Yeah. So they mentioned here validation. When they initially did a B200 deployment, the contract was almost immediately on a multi-year basis upon commission. So they were able to buy these GPUs without any form of contract hand. Once they had it running, somebody needed that GPU right away, and they contract for a multi-year right off the bat. Now, they mentioned that obviously as you build more and more, they already have a certain fleet. So it's not like big risk. They take smaller risk over time. So the risk mitigation gets a little bit smaller. So the best thing you can do is to continue ordering the hardware. If it snaps up as soon as it's commissioned, that's a pretty good sign that you're doing the right thing. Obviously, if you kind of start to see maybe things slow down, you should slow down the ordering. But this is one of the things that has drawn them to be very profitable in the Bitcoin mining operations, because you want to be the first. You want to do it as soon as possible. And that's something that Iren has done. GPU capacity in British Columbia, about 60,000 Blackwell GPUs, Horizon 1, potentially about 19,000 GB300s. The Seawater Hub, when it fully comes online, it has the potential of 600,000 liquid GB300 GPUs. Obviously, there could be the Rubin Vera or whatever from NVIDIA, but they have a lot and a lot of power overall. So that's the first stock, and I hope you learned a lot. If you are enjoying the episode, please make sure to hit the thumbs up and the subscribe button. I'm only a few away from hitting 78,000, I think 78,000 subscribers. So would love that. My goal is to hit 85,000 by the end of the year. Now, the second stock I want to take a closer look at is one in the energy space. It's called Solaris Energy Infrastructure. This one I do own, and it's one I'm thinking of buying even more and more. Iron, I would say I'm very much invested in CoreWeave. Very, very much heavy invested in CoreWeave. I have closer to, I don't want to say the numbers, but it's definitely close to the six figures in CoreWeave right now. And I'm just bullish in this overall industry, right? Just overall bullish in the AI infrastructure space. And I can definitely see why investors are bullish in Iren. Now, Solaris Energy, ticker SEI. Year to date, the stock is up roughly 12%. It is a market cap of $2.2 billion. Now, I am more of a growth stock investor. This is one that I'm actually buying right now. I think I only have about, I purchased a little bit yesterday, about $10,000. I think I'm going to increase my position over time on this, but I don't think I will make it anywhere of a six-figure position. With Solaris Energy, I've always understood, and we hear it from Iren, that power is a key constraint in the AI space. But one of the things that has bothered me is a lot of these power companies are already 20, 30, 40 billion dollars in market cap. And for me, the growth opportunities just isn't there. With a market cap of $2.2 billion, if they execute pretty well, this can definitely be a multi-bagger, right? And it seems like based on the overall movement right now, there's some excitement on the stock, but I think it can still run. Now, I do want to shout out Semi Analysis. This is on their free side. They didn't recommend this stock, but they mentioned that Solaris Energy Infrastructure is one of the companies right now that is working with xAI on rental turbine on renting their turbines, right? So xAI is using them for their AI power needs. Now that got me to do a little bit more research. And again, back here to fiscal.ai. If you are a long-term investor, you need it. Check out fiscal.ai/OZ. Now, Solaris, if we can see, historically hasn't been doing much of a revenue growth, except starting March 25th and June 25th, where they saw massive revenue growth. They did do a few acquisitions, and that has helped out dramatically. But I do believe with the kind of strength of the AI market, it's also going to continue. Now, very similar to a lot of these, lower rates is going to help them obviously, because they are building a nice amount of debt, right? They are building a nice amount of debt as they either make acquisitions, buy a lot of inventory, continue heavy capex. I think that is needed, unfortunately, in this overall market. Total cash about $140 million, long-term debt of about $520 million. Now, they also recently did complete another acquisition, and we have to see next quarter how that really pays out with with their overall balance sheet a little bit more. But overall, right now, the balance sheet looks crazy. It doesn't look that well. And that's what we're seeing with a lot of these AI players. And this is one of the big things. If this AI market is not as big as it seems and it dies down, these companies will have that dominoes effect that heavy debt is going to push them in the negative direction pretty quickly. Now, in forms of forward PE ratio sitting at 35.66, again, if you have the potential to grow, I don't think that's necessarily the worst case. Now, Solaris, again, energy infrastructure player, they provide turbines and they provide it in the modality way where you don't have to put everything at once to help build these AI infrastructures. And that's actually really good for AI data centers because AI data centers, right? You don't need all the power at once. You build them in trenches. We're seeing it with all these other companies and they help out a lot with that. Now, let's pull up their overall presentation. This presentation came out on September 1st of 2025. They talk a lot about their business overviews. They hit two markets, business segments, and they hit the power solution. And this is exactly what you think, right? They provide power solutions for hyperscalers, data centers, microgrid, utilities, manufacturing, mining, refinery, gas infrastructure, and they provide logistics. In forms of revenue, most of it comes from power solutions. Very little comes from the logistics sides. Here we can kind of see their expected power capacity, quarter two, about 600 megawatts. In the first half of 2027, they expect about 1.2 gigawatts of their own, but they also have a joint venture that they own roughly 51% of it. And the other partner, JV partner, owns 49.9%. I believe this is XAI, and this is the joint venture, but that's 450 megawatts there. So they have about 1.7 gigawatts of consolidated power. Now, future potential beyond 2027 is they see data centers that could need about 5 gigawatts each of power within the next few years. That's overall the massive growth thesis here, right? The opportunity that these data centers are just going to get bigger and bigger. Now, in forms of adjusted EBITDA, you can see they make a nice amount of money of this, potentially expected to be built more and more over time. Now, here is their revenue. They made a few acquisitions, so the business has transformed. Their legacy business used to be about 100% logistics solutions and 80 to 100 million annually of adjusted EBITDA. Now, with power solutions being 70%, that has changed completely. And we can see the market, they expect an illustrative future beyond 2027 and plus that it can grow even 100% from here, and mainly thanks to the power solution market. Now, here for the first half of 2027, data center contracted is already about 67%, and available capacity begins in the second half of 2026. A lot of the power that they have right now is contracted within the data center space. Now, again, one of the biggest reasons is why the data centers need more power. The chips themselves are getting better in forms of energy per performance, but you need more total compute, which overall increases the overall power use. And future data centers, you're going to see these servers, individually racks, be running about 1.1 to 2 megawatts and multiple gigawatt campuses. This is the growth opportunity for the power needs. They recently did an acquisition of HVM VLV in August 2025, and you can see how they go from just the generation phase to now providing nice amount of distribution products as well. Now, this is a specialty provider of complex electrical control and distribution equipment and associated engineering and technical design services. And here again, we can see the data center. Here you can see their turbines, right? Most people, I guess, when you think of turbines, I think you think of something else, but usually they look more like trailers. And they mentioned that large turbines are well suited for modular scaling to serve large power needs while still providing flexibility redundancy, and minimizing downtime risk, right? You can kind of build it in infrastructure. And so that's exactly what happens in data centers, right? You don't need all the power at once. For example, when you're building a data center, maybe the data center, you're just turning on the first batch here. So you have this modular scaling. Then when you build up the next one, you have this modular scaling and so on and so forth. So I also have another presentation for you. So for them, the data center growth is the biggest opportunity, as we saw. The AI powers right now, powering AI revolution is the biggest growth opportunity. AI power needs, and the CEO believes that, just like many CEOs, we're still in early innings. Now, in forms of competitive advantage, they have that hybrid and modular structure. The hybrid approach delivers optimal redundancy and reliability. Modularity allows customers to scale power capacity in increments as needed, a perfect fit for the AI applications that rarely require full peak from start. Again, this is I showed the image. This is what their modular build out means. And we see it with a lot of big players. Now, what are one of the biggest bottlenecks in this space, though, is equipment and long lead times. One of the things is that Solaris open megawatts aren't available until the second half of 2026. This contrasts with the real time, immediate needs often seen in the market. So, again, you can maybe see some quarters where things might not be as exciting because you're just waiting for the power to turn in. But overall, the opportunity does seem to be there for a multi-year investment. Now, those are the two stocks I wanted to kind of discuss in today's episode. I hope you guys learned a lot. For me, I am more interested in getting into a power space right now, and something below 10 billion gets pretty exciting for me. So right now I'm starting off with this, and this is probably my entry to learn more about different players in this market. If you have any below a $10 billion market cap that you want me to research, definitely check it out. Definitely let me know in the comments below. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you all next time.